or you can write, but you will not finish it. But I hope you can finish the question. That will be good. So don't lose the focus. We are doing financial accounting. We are doing financial accounting. That is intermediate foundation level. And the topic here is partnership. And the topic here is partnership. So make sure that your internet or your space is good. So the topic is partnership. And the illustration we are doing here is for December 2022. That is for Mercy and Get Mercy Nixon have been trading as a partners under the name Common Partnership. Then they have told us the partners share the profit and loss in the ratio of 3 to 2 respectively. Full stop. On 1st November 2021, an employee, called Oliver, was admitted as a partner. He was to bring in 1.75 million as capital and 1.608 as his shares. Then the partners do not intend to open a goodwill account. This was a good examiner. He didn't want to have the goodwill account. Then we have been told the admission of Oliver has not been fully recorded in the books of account other than the cash record. So they record the cash. So how do we remember here is an accounting, financial accounting, and we must know how to do a double entry. You must know how to do a double entry. If a partner or any else bring in capital, what do? We debit which account, we credit which account. So we credit capital account and we debit cash account That's what this examiner is telling us. So you have to credit that 1.75 in capital account and debit the cash account or bank account Then they have given us the trial balance, which I will not be able to read all the values, but we have the capital account for all the partners. We have the current account, we have drawings, we have land, furniture at cost, we have motor vehicle, allowance for depreciation, that is on 1st November 2021, that is accumulated depreciation. We have furniture and fittings, and then we have account receivable, account payable. So those are just asset and liabilities, which they don't have any adjustment. So where there is a challenge and where there is a problem is additional information. So how do we do, or how do we tackle this additional information? Number one, we have been told the new ratio or the new profit sharing ratio for agreed partners is 4 to 3 to 2 to 1. That is after admitting a new partner, that is Oliver. And then Nixon, and then number two, we told on 31st October 2022, inventory was valued at 5.78 million. That is closing inventory. Then number three, as at 31st October 2022, accrued salary and wages and accrued advertising expense amounting to 1.7, 1.79, and 1.68. Those are accruals. I hope we know how to treat accruals. How do we treat accruals? If you have accrual at the end of the year, it means you have not paid that accrual. So it must have two double entry. You account under the income statement as an expense, so you add back to that expense, and then you remember to recognize as accruals at the end of the year under the liabilities. Under the liabilities, that is the treatment of that note. Number 4, we have the prepayment. The same case with the prepayment. You recognize as a current assets, and also you adjust the expenses. You adjust the expenses. You adjust the expenses. So kindly, so if you are in a noisy place, you can mute. Also, number 6. Number 5. Was better agree that.
Excuse me.
Yes.
Pardon, how we treat the accruals.
The accrual is remember, when we talk of accrual, it is not asset, it's a liability. So here, like for that one, for that case, that is salaries and wages, salaries and wages. We normally know salaries and wages are expenses, But what is in that trial balance is that what they are paid in the bank. So what is in the trial balance is just what they are paid. Is just what they are paid. But in the additional information, they have not paid other salaries. Maybe it is 1 or 2 employees. So what do? You add back to this amount. You add back to this amount so that you get the total salaries and wages expenses. So that you get the total salaries and wages expenses. And this amount have not been paid. So this amount have not been paid. So what do? You recognize under the current liabilities as accruals. So for those of you who have been in our field, you know how to account for NHIF, NSSF, and payee. So it falls under this one, accruals. So ukifanyanga the year-end financial statement, that's what you normally do. So I hope umeshapata hiyo. And then it is the opposite with the prepayment. It is the opposite with the prepayment. It is the opposite with the prepayment. Remember, when we talk of income statement, we only recognize for 1 year. We only recognize for one year. But this person has paid for up to the next year. So we don't need any value for next year. You will account in that year. So what do? You subtract from the current financial year. So you subtract from the current financial year, and then you account under the current assets. You account under the current asset as a prepayment. And actually, that is the only adjustment for financial accounting. Ni prepayments, accruals, na depreciation. So let's now start this question. So there is a lot of adjustment in this question for revaluation. There is no goodwill